Kikoff starts at around $5 a month, while credit-strong plans can start much higher depending on the account you choose. That price gap matters because both are trying to solve the same problem: building credit from scratch or rebuilding after damage. By the end of this, you'll know which one gives you more value based on cost, speed, and how aggressive you want to be. Here's the direct answer. Kikoff is built for low-cost, simple credit building. Credit Strong is built for people who want bigger payment history and stronger installment loan reporting. That difference changes everything. Start with Kikoff. Kikoff works like a revolving credit line with a small monthly subscription. You make your payments, the account activity gets reported, and over time that builds payment history. That makes it beginner-friendly. There's usually less money at risk, and the commitment feels lighter. If your budget is tight, that matters. But Kikoff has limits. Because the account size is small, it's more of a slow and steady tool than an aggressive rebuild strategy. Now, Credit Strong. Credit Strong works like a credit builder installment loan. You make fixed monthly payments, and those payments are reported to the bureaus. At the end, you get back the money you paid in, minus fees. That structure gives you two things at once: payment history and forced savings. That's useful if you need discipline. It's also useful if you want a larger installment account showing on your report. The downside is cost. Your monthly payment is higher, and your commitment lasts longer depending on the plan. So which one builds credit faster? It depends on your profile. If you have no credit at all, Kikoff can be enough to start creating positive history. If you already have bad credit and need stronger signals, Credit Strong usually carries more weight because installment loans add depth to your file. Think of it like this. Kikoff is lighter, cheaper, and easier to maintain. Credit Strong is heavier, more expensive, but can create a stronger long-term profile if you stick with it. The mistake people make is picking the bigger plan and quitting after 2 months. Consistency beats size here. So the quick breakdown. Choose Kikoff if you want the cheapest entry point. Choose Credit Strong if you want bigger credit building impact and don't mind the higher monthly cost. Your next step is simple. Check your cash flow and pick the one you can keep for at least 6 months. If this helped, like the video and subscribe for more credit comparisons.